So let's take a moment looking at accounting and in particular financial statements. I'll open up a presentation. You have four basic financial statements: the income statement, the statement of retained earnings, the balance sheet, the statement of cash flows. The income statement is going to measure for a very specific time period whether or not you've made money or lost money with operations and non-operating activity. We'll see that there is what's called a stair step or progressive fashion to the financial statement, the income statement, but it covers a very specific period of time, perhaps a month, a quarter, or a year, but it will be a very specific time period. This is the step-down effect. There are, as we look at our income statement, several points where we want to stop and compare ourselves to where we were in the prior year or how we're doing against, for instance, our competition or peer group. So the first stopping off point is gross margin or gross profit, where in order to arrive at gross margin, you would take sales minus cost of goods sold and determine what kind of level of gross profit has occurred at that point in comparison to where you were a year earlier or where a competitor is. If we then take gross profit minus expenses, you're able to calculate operating income and use that subtotal, operating income, to compare where you were a year ago, same time last year, or to compare to your budget, or to compare to a competitor. Once we take into account interest expense, we've arrived at, so now we've got gross profit minus operating expenses minus interest expenses allows us to calculate something called earning before tax. This is another stopping off point for comparison to ourselves or to others. Finally, taking into account taxes means that we've taken sales less cost of goods sold, less operating expenses, less interest expense, minus taxes gets us to earnings after tax or net income. This is often called the bottom line. Here's a financial statement that demonstrates that. The Kramer Corporation, sales of $2 million, cost of goods sold of 1.5, gross profits of $500,000. So that's the gross margin, $500,000. Less operating expenses that include selling and administrative expense, depreciation expense, allows us to subtract expenses of $270 and $50, giving us operating profit of $180,000. Minus interest expense of $20,000 takes us to earnings before tax of $160,000. Taxes are at $49,500. So our net income, or bottom line here, is $110,500. You can see in this particular income statement that some of the net income or bottom line is shared with preferred shareholders, and then a dividend has been paid out. Notice that the heading. The heading says that this is Kramer Corporation income statement for the year ended December 31, 2013. So we've measured sales and all of its expenses and various other deductions from revenues for that 12-month time period specifically. In terms of the statement of retained earnings, we like to think of that as a company will have some earnings, or it has a loss, but let's assume we're dealing with a company that has some earnings. The earnings go only one of two places. You either share some of those earnings with your investors by paying out dividends, or you retain the earnings and keep them on your balance sheet through increasing the retained earnings account. So the statement of retained earnings is a rather simple financial statement. Again, this is for a specific time period, for the year ended December 31, 2013. And you can see that the period opened with retained earnings of $250,000, to which we add net income of $100,000, and then the organization decided to share $50,000 with investors by paying a dividend, meaning that our ending retained earnings balance is $300,000. The balance sheet, unlike the first two financial statements, is a point-in-time measurement. We will strike a balance sheet at the end of the month, at the end of the quarter, or at the end of the year, but the balance sheet is only valid on that particular date. The day following the completion of a balance sheet, balances continue to change on the balance sheet. So this measures our financial condition at a point in time, and it will show us the levels of assets, liabilities, and owner's equity, and we need to be aware of the accounting equation of assets equal liabilities plus owner's equity. This point-in-time measurement shows us whether or not we have financial strength or financial weakness. If we have assets that are much larger than our liabilities, then we're going to have a large amount of owner's equity. If we had liabilities that exceeded our assets significantly, then we would have negative equity. So the balance sheet helps us look at our financial condition. Some of the accounts you're going to see: current assets. Those are assets that you expect to use in the upcoming year in your operations. Marketable securities involve temporary investments. That marketable meaning that they can readily be sold in the financial markets. Accounts receivable are those monies owed to us through sales, where we've sold product to customers and extended them credit. Accounts receivable will be stated minus an allowance for bad debt, so that we're stating exactly what we feel we will collect in terms of accounts receivable, minus any bad debt that could occur. Inventories are in the form of finished goods or work in process. These accounts capture goods that are either ready to sell or in the process of being made ready to sell to customers. Prepaid expenses are those things that we've paid in advance. Typical example is rent. Oftentimes companies will pay rent 3 months or 6 months in advance. Insurances work that way as well. Investments are longer-term investments of excess funds. These are stocks and bonds, typically. Plant and equipment are those fixed assets or resources being used by our company to ultimately generate revenue. We will state these as original cost less accumulated depreciation on the balance sheet. The liabilities or obligations that we have to others through the conduct of our business. We have short-term liabilities and longer-term liabilities. A couple of examples of short-term obligations are accounts payable and accrued expenses. Longer-term liabilities might be long-term debt, pension obligations. Finally, we get to stockholders' equity, where we will have balances attributed to the issuance of common stock and retained earnings, as well as preferred stock. So that's a very quick review of the kinds of accounts we will find under assets, liabilities, and owner's equity. Now, this is a balance sheet, kind of small for us to view, but we can see that we have total assets of $1 million. That will equal the amount of liabilities plus owner's equity. And liabilities, in this case, are $300,000, which means that owner's equity would be $700,000. So that's a fairly strong balance sheet at first blush here. We have assets of $1 million and only liabilities of $300,000. If this company went out of business today, the assets of $1 million would be used to settle all the liabilities of $300,000, and we would have $700,000 remaining. That makes for a strong balance sheet, and you can see that it's stated as of December 31, 2013. The statement of cash flows is important because we complete our income statement and our balance sheet based on the accrual method of accounting, but it's necessary to always know how well you're positioned in terms of cash. So we complete a statement of cash flow. Statement of cash flows comes in 3 sections: cash flows from operations, investing, and financing. We would have these sorts of activities driving operating cash flow, investing activities, as well as financing activities. You're advised to look closely at this particular diagram, which can also be found in your text. More than 90% of all companies use what's called the indirect method to complete their statement of cash flows. We start with net income, adjust for depreciation, and then we look at the changes in current assets and current liabilities in order to determine whether or not we've had cash flow from operations. This is a comparative financial statement, a comparative balance sheet showing one year versus the next. This is a statement of cash flows. The operating activities, an example of investing activities, investing in property, plant, and equipment, for instance. And finally, in financing, raising funds through the issuance of bonds or issuance of stock. We will discuss the statement of cash flows in our class meeting. And that is a brief review of our 4 financial statements, being the income statement, the balance sheet, the statement of retained earnings, and the statement of cash flows.